Okay, I guess we're ready. Well, welcome everyone to the St. John's University Power Hour number 13. As I mentioned to Pat and Keith during our test run, lucky 13. I don't know, 13 is your lucky number. It's, I'm sorry to say, not my lucky number for obvious reasons. WebEx, I think, knows that 13 is not my lucky number. So let's hope that I can stay on during the entire session. I hope so. We'll see what happens. But I know some of you that are that signed on today are new to the Power Hour. We, as you can tell by the number, we are up to our number 13 Power Hour. It's been a great experience. It's been great speaking to so many faculty members, friends of mine who are experts in their field. And, you know, Pat and Keith, I welcome you and thank you so much for joining us today and sharing your expertise about life insurance policies. I chose the word Power Hour because I felt like when we started during the quarantine that everyone was inside and we needed to be energized, and I just felt it was a great way to stay connected with our donors and with our alumni. And I really look forward to Tuesday afternoons because I get to see everybody and hear from everyone. And it continues during the week because everybody follows up with me on questions and comments about our electronic newsletter, which I hope everybody is receiving, and about our Power Hours. So it's really great. And I hope everyone is staying safe and everybody is well. So we're going to get started. I just wanted to ask Pat and Keith real quick before I introduce you and share you know, your background with everyone. But what have you been seeing right now with the life insurance industry during this pandemic, you know, overall in terms of the industry itself? Do you feel like some other industries, like we were talking earlier about restaurants and so forth, do you feel it's going to be evolving now after the pandemic is soon to be over?
Yeah, Pat, do you want to jump in first, or?
Yeah, you know, Susan, I definitely feel that there's definitely a change taking place. We're going to touch on that obviously a little deeper in the presentation.
Mm-hmm.
Personally done obviously a lot more virtual meetings and have done business virtually because the landscape of just doing business has changed in the sense that everything is electronic now.
Mm-hmm.
So we've been trying to get away from paper applications, and now it's pretty much mandatory that all of our applications be done electronically. So I've done business with individuals in Florida, in New Jersey, cuts down on the travel time, on the gas,
Right, that's good.
all that stuff. So it's more efficient, and we can get the job done just as easily through the computer.
That's great.
Yeah, and I would second that, and I would also say that, I mean, you're seeing, we talked about how companies will have to adjust. Some of it may be looking at the space you now maintain. So you may be cutting back on space, having more people work from home to accomplish some of that saving and some of the costs associated with that. But the other thing I've seen is really a strong ramp up in technology. I mean, some of this technology has been available, but most people have kind of pushed it off.
That's true.
know it's available. But now we've seen more and more people start to embrace it because of the world we're living in today, which, to Pat's point, it's eased some of the way we do business, the way we complete business, the way we can compete for business moving forward, the way we can communicate with clients moving forward. So the insurance companies, just like every other company out there, had to evolve, just like many of these other companies are evolving during the pandemic. And I'm sure there's going to be more change to come.
No, I'm sure we're going to see that. And as we mentioned, creativity is, I think, key on how companies can evolve and in creative ways to make it easier for their employees as well as their customer base. So with that said, this Power Hour is about the changing landscape of life insurance during this pandemic. And we have Pat Gravino, who's a financial consultant for Equitable, And Pat provides financial strategies for wealth creation, preservation, and estate planning strategies through a broad range of financial products and services. And prior to joining Equitable Advisors in 2006, Pat, you practiced law for 4.5 years. And you were saying that you found as your time in practicing attorney that you've acquired invaluable skills that were easily and quickly transitioned into your current career as a retirement, asset management, and estate planning specialist with AXA. And then you have your colleague, which I'm so glad you were able to join us as well, Keith, Wziontko, and he is the Regional Vice President of Life Sales for AXA Distributors. He began his career in the financial services industry 20 years ago. His career path has enabled him to take on several key sales roles within a number of insurance companies, and these roles include working as an advisor in a bank channel, internal wholesaler, sales desk manager, national life sales program manager, and a director of national accounts. He's been with AXA for 7 years, the last 6 years as regional vice president. So it's so great to have you join us as well. So we're really interested in hopefully learning more and seeing how we can, if all of us have life insurance policies or thinking about it, how we can better utilize this type of financial vehicle. So am I turning it over to you, Pat?
Yes, Susan.
Okay,
Thank you.
great. Thank you.
All right. Well, good afternoon, everyone. First off, I hope everyone is remaining healthy and safe during these trying times. I am going to share my screen right now. Okay. Let me just see if I can move this. Okay. So everyone can see my screen?
Yes.
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 Sorry, I muted myself. You all muted us. Okay.
No problem. So once again, thank you, Susan, for giving Keith and I the opportunity to present this afternoon to many of the St. John's donors and alum. What we're going to cover today is life insurance as an asset for today and tomorrow, as well as how we're dealing with this pandemic and these uncertain times. I'm trying to switch. There we go. So what we're going to cover today, here's a little agenda for us, a breakdown. I'm going to cover sections 1 and 2, and then Keith is going to jump in for the tail end of the presentation. So crisis creates clarity and the opportunity that presents, the benefit of reviewing existing life insurance and the mistakes that are uncovered. And then, as I mentioned, Keith is going to talk about leverage and a gifting strategy and utilize charitable giving as a approach to overall financial planning. And we're going to leave questions to the end. I think that's how you guys typically handle it. You go through the presentation and leave some time at the end for some questions.
Perfect. Thanks, Pat.
You got it. Okay. So not to kind of beat a dead horse here, but we're in the midst of this global pandemic, millions of Americans being impacted, the economy being shut down. Every industry, as we mentioned earlier, Susan, is impacted by this, including our own industry. We have historically low interest rates, 10-year treasuries at an all-time low. And all of these things that are currently taking place are causing insurance carriers to have to adjust their underwriting. I would say about two months ago or so, Barron's had an article specifically geared towards what certain carriers are doing during this pandemic. And as you can imagine, with unfortunately, over 100,000 deaths in the United States, these carriers are facing claims at a large rate that they didn't know we're going to be experiencing all at once. And when that happens, unfortunately, that causes companies to increase cost. There's talk of potential exclusions for future pandemics being written in policies. And there's actually certain carriers out there that have chosen to stop insuring individuals over the age of 70. Luckily, here at Equitable, that I represent, we have made certain changes. We haven't made any drastic changes. And we're stopping writing policies at age 70. We haven't put any exclusions in place. However, we have changed underwriting classifications, at certain ages as well as so we're going to talk about this, product changes, repricing in the industry, and we're going to talk about how important it is to continuously review any existing policies, as well as take a look at some of the reasons why, if you have been considering purchasing life insurance, why, taking the first steps to actually get that done right now may save you, I should say, a significant amount of money in the future. So the opportunity that Keith and I have found, and a lot of advisors have found, is that, many people are working from home and they're taking this opportunity to get their so-called financial house in order. And what do we mean by that? Well, many people are reviewing their existing documents, their wills, their trusts, their qualified plans, their life insurance policies, just to make sure that everything is still in line with the goals and objectives that they once had when they initially took these programs out. And we're in a forever changing landscape, and it's very, very important. And we're going to see that in the next couple slides. Very important to review some of these important documents and programs that are in place, that a lot of times we set them up for the right reasons, and then we kind of forget about them, put them in a drawer, put them in a safety deposit box in the bank, and we don't really look at them until something happens. We've found clients are worried. Do they have enough to protect their family? Personally, I've done about $40 million in term insurance this year. Term insurance, as many know, is quite inexpensive, satisfies a short-term need, but people are thinking about their life expectancy, their mortality. These things are on the minds of people and typically are put to the back burner, but now are at the forefront, being that the environment that we're in. Very important, as we'll see, reviewing existing beneficiaries, not just on your life insurance, but also on any qualified plans you may have through your employer and/or personal plans, IRAs. Again, we alluded to the virtual meetings. A lot of clients seeking advice these days, and it's very easy for us to hop on a Zoom meeting or a WebEx, share our screen with you, and kind of review what you're currently doing and make sure that things are structured properly. One of the most important things in the financial planning process, I feel actually the foundation, is protection. And by protection, we mean risk management, health insurance, disability, life insurance, long-term care. I equate that to, I have a 6-year-old daughter. I put money into her college 529 plan every month, but it's not self-completing. And what do I mean by self-completing? Let's just say I'm putting away $500 a month for the last 5 years. So I'm putting away $6,000 a year. That's $30,000 plus or minus growth. If I pass away prematurely and I'm not here tomorrow, all she has in that college plan is, again, $30,000, my initial contribution, plus or minus growth. So in order to counteract that, life insurance creates leverage. And life insurance is what I have in place to protect against premature death, so that, God forbid, something were to happen to me, it's not only $30,000 that she has, but she has, 10 times that amount or more to make sure that she can go to college, to make sure bills are paid, so on and so forth. We good so far, Susan? Everybody's good?
Very good. Thank you, Pat.
Okay, just wanted to check in.
Yeah, we can hear you. Thank you. Appreciate it.
Perfect. You got it. Okay. So as you see on the screen, the benefits of reviewing existing life insurance. Now, there are many benefits. We can talk for days on end. I know life insurance is not the sexiest of topics. I'm trying to provide you with some key points that you can take away from this presentation and either go back and implement or take a look at whether you need to make any changes to your existing policies. So as we know, life insurance is a dynamic and valuable asset, provides a means to pay off debt, replace lost income, and these policies must be reviewed. I'm going to give you a little quick story that took place when I first came into the business. This was back in 2006. Of course, I went to my family, who were ultimately my first clients. My dad had an old MetLife whole life policy that he took out in the 80s. And I said to him, I said, let me take a look at it. Let me review it. And being the old school, thick-headed, stubborn Italian that he is, he said, no, everything's good. It's fine. The guy told me I need to pay for 10 years and the policy would be self-sufficient. I said, okay, that's great. Let me take a look at it. So lo and behold, we did what's called an in-force illustration. Susan's very familiar with this, as I helped her with some of the donors' policies. An in-force illustration, what that allows us to do is take a look at the current projection of the policy based on either current interest rates or current dividend scales. Now, as you can imagine, back in the 80s, the dividend scale of most whole life companies was fairly high. So the proposal that was shown to my dad projected an 8, 9, or even 10% current dividend at that time. So paying for 10 years may have made sense in that environment. However, looking at it in today's environment, or back in 06, that dividend scale has drastically come down and has come down even further since 06 to the present, based on the current interest rate environment that we're in. So what that illustration showed was that his policy was going to lapse at age 81. And by lapse, I mean the cash value that had accrued was going to be eaten up to pay for the increased cost of insurance. So you can imagine the conversation that my dad had with the agent who originally sold him that policy. Lo and behold, I was able to preserve the policy through a 1035 exchange, which allowed me to take the initial cash value in the policy, move it to a new policy. Again, we're going to touch on the new features and benefits that are available that were not available back then. And we were able to get him more coverage, a reasonable premium moving forward to sustain that coverage, and different features and benefits. So that's just one example of many of why it is so important to review these policies. We also want to review beneficiary designations. People may be divorced and have an ex-spouse on a policy. A new spouse would not be too happy about that if they found out that an ex-spouse is still the beneficiary. And just so you're aware, a beneficiary designation trumps any designation in a will that you might have. So that would take precedence. Moving on to the second topic, business use of life insurance. I do a lot of work in the business community, wherein we help business owners protect against financial loss due to an untimely death of a business partner. That's typically referred to as a buy-sell agreement, where we make sure that each partner's interest in the business and their family's interest is preserved. Retention and replacement of key employees through key person insurance programs. That's important to attract and retain key employees, and there's certain tax advantages associated with that. And this all kind of comes together with the changing landscape of the life insurance industry and the programs and policies. A lot of businesses were startup businesses and have evolved. So what was once an evaluation that they did in the early stages of their business has certainly changed as that business has grown and evolved. So once again, that causes the need to revisit and review any existing programs that are in place to make sure that it still fits the goals and objectives that those business owners have at this point in time. Just trying to get to the next slide. Okay. So what I'm going to touch on now, and I'm also going to provide Susan with a very, very detailed piece that can be distributed to everyone on the call that really reviews the 10 common life insurance mistakes. These are bullet points that I'm going to address and also expand upon, but the piece will really dig into details on any of these that may be of importance to you. And then once I wrap this up, I'm going to turn it over to Keith. So 10 common life insurance mistakes. Number one, you name your estate as a beneficiary. Why is that a mistake? You always want to name an individual person as a beneficiary. If you name an estate, what happens is you subject the policy to probate. And what that means is that a court first of all, it's going to be held up in court. So it's not going to go to the potential intended beneficiary because the court's going to decide who it needs to go to. And there could be some tax consequences associated with it as well. So very important to make sure that an individual is named as the beneficiary. Make sure that that's the case on any group term insurance that you might have through an employer, as well as any individual policies that you may have. Number two, you failed to name at least 2 backup beneficiaries. Why is that important? Well, let's say the primary beneficiary predeceases you and you never make an update to that beneficiary, and there's no contingent beneficiaries on file. Well, that brings us back to mistake number 1, because then your estate is going to be named as the beneficiary. So we employ the rule of 2. Name 2 backups for every person named in your life insurance policy as beneficiary. And that's also a good practice with regard to your wills, your trusts, any profit sharing, pension plans, qualified plans through your employer, as well as any guardians that you may have for your children. You might have a primary guardian. Again, they predecease you, haven't named any backup guardians. Your true intentions may not be carried out if you leave it up to a court to decide who the guardian of your child is going to be. So that's number 2. Number 3, I touched on this already. I'm not going to belabor this, but check your policies at least every 3 years. Number 1 was my dad's story. Number 2 is beneficiary designations. I've seen situations where there was a second marriage and subsequent children from a second marriage were excluded unintentionally. They were meant to be included, but these things just get put aside, not reviewed, not looked at, and can cause strife down the line that could be avoided by just putting a reminder to review these things every so often. Mistake number 4, you haven't matched the product with the problem. So a lot of times we use a Band-Aid approach. We tack on some term insurance because it's cheap, it's inexpensive, but it may not be the right approach to the problem that you have. Term insurance is great. I own term insurance personally. It satisfies a short-term need, but more often than not, we couple term insurance with permanent insurance to satisfy multiple needs and to give you flexibility down the line in case you're still in need of some protection upon termination of your term insurance policy. So that's number 4. And also to continue on number 4, products change. There's many different products that are available today that were not available 5 years ago, 10 years ago, that can significantly enhance your current portfolio. So the biggest kickback that I typically get when I meet with a prospect is I'm already all set, I'm taken care of, I have insurance, and if I haven't made an argument already to review what you currently have, you're going to hear a few more stories throughout this presentation that are pretty alarming and can cost people, forget about tens of thousands, but millions of dollars if not adequately set up and properly set up. Number 5, the amount of your personal coverage is inadequate for your financial security goals. More often than not, when I'm meeting with a prospect and they have existing life insurance, I ask them a simple question of how did you come to the determination of how much coverage you have? And more often than not, I get a blank stare, or I get, oh, I don't know, they just told me $1 million. It was a nice round number. When you sit down with someone like myself or Keith, we're going to do a full life insurance needs analysis, whether you have current coverage or whether you're looking for coverage. And that needs analysis incorporates a 5-pronged approach. We need to look at debt replacement, income replacement, college expenses, emergency reserve, and funeral expenses. And until we go through each one of those rungs of the ladder, you could be overinsured or you could be underinsured. We don't know which way it is, but more often than not, we find that the insurance that's currently in place is not the proper amount of insurance, whether it's over coverage or under coverage. And it's an exercise that we feel everyone should go through, whether they have coverage or don't have coverage. to just make sure that they understand the reasoning behind why we're recommending the amount of coverage that we're recommending. Number 6, your policy is payable outright to a minor or a grandchild. Goes hand in hand with number 1 and number 2. You typically do not want to name a minor as a beneficiary because, once again, the minor is not going to be able to take access to those proceeds. A guardian is going to need to be named. If a guardian is not named already, it's going to, again, resort back to the courts, hold it up in probate, and potentially have a judge decide who gets the benefits of the policy or when they get it, or the restrictions around how they get it. That can all be avoided by, if you want it to specifically go to a minor or a grandchild, update your will or trust to designate how you want those proceeds to be paid, when you want them to be paid, and who's going to be monitoring those proceeds until the minor reaches the age of majority. Number 7, I have a little story on this one that's interesting. All your life insurance is owned by you. So about 7 years ago, I approached a pretty successful business owner in the community where my office is in Astoria, and I asked him how much life insurance he has. And he told me that he had an $8 million term insurance policy. And my next question was, Steve, who owns the policy? His response was, I own the policy. Now, me knowing that this individual was already worth 30 million plus, realized right away that the problem he was looking to solve was actually being exacerbated by having an individually owned life insurance policy, as that $8 million was now included in his taxable estate. So the simple question of who owns that policy allowed me to not only take over his coverage and change it to the appropriate classification that it should have been, which is in a trust, which is referred to as an ILIT, an irrevocable life insurance trust. Now that asset is outside of his estate and not included in his taxable estate, which was the very essence of why he was taking the policy out. So that just goes to show you, and we're going to talk about that at number 10. I'm not skipping to that, but when you look at something as a commodity and you're not dealing with the right individual in this industry that's just looking to make a sale and move on to the next client, that's what happens. The policy becomes individually owned. There's a 2-year look back period. So we had to then incorporate a trust, move that policy into the trust, and avoid a much bigger potential tax liability that was looking to be avoided by the purchase of that policy. So again, take a look at that. Make sure that if you do have an estate tax issue, or if it's something that may come down the line, that your life insurance is titled properly. Number 8, you haven't checked to see if your business or professional practice can provide insurance on a more efficient basis. I'm not going to get into the weeds with this because it could get pretty complicated, but there are ways in which you can purchase life insurance inside of a qualified plan, and that can afford you some tax advantages associated with the way that the coverage is structured. So coverage can be purchased inside deferred compensation plans. There are certain programs wherein you insure a key employee, you get a tax deduction. The employee is responsible for the taxes on the contribution. That's called a Section 162 bonus plan, where the employer can then bonus the employee the amount of taxes that they would have to pay as a result of having that policy placed on them. So we can get into detail. Anyone that wants any further information, I'm going to leave my contact information at the end of the presentation, and I'm happy to discuss that further. Number 9, you forgot that term insurance runs out and/or becomes prohibitively expensive to carry. Again, term insurance satisfies a short-term need. However, if and when the need comes that you want to continue that coverage beyond the 10, 15, 20-year period in which you have it, you may want to look at certain options that a carrier may provide that allows you to convert that coverage during the time period of the term insurance, or see whether it makes sense to purchase a new term insurance policy when the existing one expires. I have a friend of mine that had a 20-year term. He wasn't paying attention. The term expired. He just continued to pay, and the premium jumped up 7 times the amount on a monthly basis for what he was paying. I then tried to assist him in purchasing a new policy, and lo and behold, he had some medical issues that are preventing us from purchasing a new policy, and now he's stuck with paying an exorbitant amount of money to continue this term insurance. So again, typically what we do is we do a combo approach. If it's important to get to a certain amount of coverage, we will utilize term to get there, as it's inexpensive, and then we will couple that with some permanent insurance to give that flexibility to continue that coverage when the term expires. And number 10, buying life insurance as a commodity. I've had this happen to me. I've had people tell me I want the cheapest coverage that's out there. As we all know, cheap does not necessarily convert to the best coverage that's out there. When it comes to protecting your family, I mean, this is my opinion. You don't want to buy the cheapest thing that's out there. You want a company that's sound financially, that's going to be there to provide for your family if something were to happen to you. It doesn't mean that you have to pay a lot more money for it, but more often than not, the cheapest company out there is the cheapest company for a reason. They may not have conversion capability on their term insurance portfolio. Their claims paying history may not be great. So again, look at the carrier, look at the rating. We represent Equitable, Keith and I. However, we do have the ability to shop around and utilize all the top A-rated companies when it comes to looking at what's the appropriate form of life insurance and the appropriate carrier based on your particular circumstances. So I am going to turn it over to Keith to finish this presentation up, and then we'll take questions at the end. Thanks, Lou.
All right. Thank you, Pat. Actually, you can jump over to the next slide. So first of all, I mean, just want to second everything that you did say. You can go back one slide if you can. Obviously, life insurance is a multi-purpose planning vehicle. As Pat mentioned, it comes into play in a number of areas: estate planning, business planning. It could be part of charitable planning. A lot of times we look at the life insurance piece of it as just the protection aspect of it, but there's also other areas where it comes into play. It can be a source of cash, and people have accessed these policies for college funding, to start a business, to purchase a vacation home. So there's cash value buildup in these policies. There's also favorable tax treatment, not only with the cash value that builds up in the policy, but the death benefits that are payable. One of the things that life insurance tends to be used quite often for is the ability to create a legacy. So being able to create a legacy for future generations, being able to create a legacy through charitable giving are big things. And when I look at it, what are some of the reasons why people choose to give in the first place? Well, if you think about giving in the first place, a lot of times, as you can see from the slide, it leads to a number of reasons or a number of motivating factors. One of the big factors out there for people to give is they have an affinity. Affinity is a strong motivator. I have an affiliation with my university or the private school I attended, and I'm very fond of them in terms of my success in life. I have an affinity or relationship with my church, or there could be certain health organizations. Think about cancer and how it's impacted families, children, adults, and being able to give to those foundations seeking a cure or better treatment. So obviously the affiliation and the personal connection with a group is a major reason why some people tend to contribute or donate time and money. Another area that we see come up for some of the reasons are obviously payback. I've done well in my life. I want to be able to give back. I feel obligated through philanthropy. There's social responsibility. Maybe there's certain things socially that I believe in or are tied to. Or think about events across the world, whether it's an earthquake in Japan and families being devastated, or hurricanes in the South. I want to be able to give there and help those families. I've also seen a number of families and donators. It starts from family tradition. In my family, we spent a lot of times as kids going to the soup kitchens. So as children, we understood the value of giving back. Memorials, keeping names alive. We see corporations, celebrities and so forth from a publicity stunt giving money to their favorite charities. And then also the IRS at the end of the day likes us to give and donate. Obviously there's tax benefits as well as financial benefits in terms of giving. Pat, if you can go to the next slide. So the one thing I will stress that Americans have been generous. If you look at some of these numbers from 2018, almost $430 billion has been given to charities. A good portion of this, obviously, there's a number of things that people have affiliations to, but almost half of it has gone to universities or education and religious organizations in terms of their personal feelings around those type of organizations. I heard Pat talk earlier about the global pandemic. That's had a huge impact in terms of charity and giving and moving forward. Some people have held off on their charitable giving. Some areas or organizations actually need more depending on the impact from the pandemic. I saw a recent article on Stanford University as an example where they have the third largest endowment in the country, but they're now at risk where they're going to have to cut back on many of their varsity sports. Considering cutting potentially 11 of those sports and looking at other things that may be cuts or pullbacks based on the impact of the pandemic and that moving forward. So obviously the pandemic has had an impact and the need for charity is still strong. One misconception I will share, there is a belief that a majority of the money that goes to charities, the 430 billion we're talking about, comes from private foundations or corporations. That is far from the truth. The reality is 60% of the charity today is given from individual donors. So then more than $230 billion has been given by individual donors, not private foundations or corporations. Pat, next slide. So, talking about life insurance and how it impacts, and it's a multi-purpose planning vehicle. One of the areas that we have seen people utilize life insurance is as a gifting strategy to many of their favorite organizations. There's three areas that I'll kind of cover today at a very high level. Obviously, there's more planning opportunities beyond this. But one of the areas when we look at gifting a life insurance policy is obviously the charity is the owner and the beneficiary of the life insurance policy. Another area is where we see donors want to maintain control of their life insurance policy. So what they do is they essentially designate their beneficiary, the charity. Or the other third area that comes into play is many times you own a life insurance policy throughout your entire lifetime. And as your needs adjust, I heard Pat earlier say we do these reviews and sometimes you need more insurance or sometimes you need less insurance. There may be an opportunity to donate your existing life insurance policy if you no longer need it. And that may be an opportunity to donate it to the charity to enhance your gifts moving forward. So we'll cover all three of these at a very high level. Next slide, please. So when we look at when the charity is the owner and the beneficiary of a new policy, this tends to be the most common way that life insurance is set up as a gifting strategy for a charity. The charity typically applies for a contract based on the donor's life. One thing that you need to keep into consideration is there needs to be some type of insurable interest. And so what I mean by that is we may have a donor that gifts annually to the charity. There would be an insurable interest there. They may be a board member that impacts the charity. It could be a volunteer that spent the last 20 years volunteering their time each week to that charity as opposed to dollar amounts, where there may be a benefit in terms of going out and having a life insurance policy on that individual. So there should be an insurable interest in terms of putting a policy in place. The donor has a choice to either gift cash to the charity, and the charity can take that cash to pay the premium on the policy, or they can gift the money directly to the insurance company. Normally, we would recommend gifting it to the charity as your deductions may be higher and going that route in terms of setting up a plan. Keep in mind, once this is set up, the charity has access to the cash surrender values, which they can use throughout the lifetime of the policy, and also can control, they are the beneficiary and the owner of the policy. Next slide, please. So the second area we talked about was many times the donor may still want control of the life insurance policy. I may be a few years from retirement. I'm still not sure if things may change. I may still want access to this life insurance policy, the cash values in it, or I may potentially still need the death benefit. One opportunity is they may keep control of the policy, but down the road, change the beneficiary to a charity. This will allow them to enhance their gift down the road if the life insurance benefits are no longer needed for family members or other needs within their lifetime. It allows them to keep control of the policy. Obviously, the beneficiary assignment is revocable and can be changed down the road. Keep in mind, there is no deductions if it is set up this way because you still own the policy. You have the rights to change the beneficiaries. If the death benefit, if the donor dies with the policy, obviously the death benefit will be part of their estate taxable proceeds. But if the benefit is also paid out to a charity, you can receive a deduction at that time against your estate taxable. Next slide. So the other last piece we talked about is, we see this quite often. I've owned a policy throughout my entire lifetime. I've had it covering my children when they were young. I had it there for protection to pay off the mortgage. Now I get to my retirement years. My kids are doing very well. I still have charitable inclinations that I want to continue to give to my favorite charities, but I don't have a need for my life insurance policy anymore. So I decide I want to go ahead and donate the policy to the charity or the organization. At that point, I would change the ownership to the charity. They would now own the policy, own all rights to the policy, including the beneficiary as well as the cash values. At that time, I would receive a current income tax deduction based on the policy being gifted or donated to the charity. Keep in mind, there is a 3-year look back rule. So if I make the change today or I donate the policy today, if I die within the next 3 years, essentially the value of that life insurance policy, the death benefit, would come back into my estate. But again, what we talked about previously, if the beneficiary is the charity, you would receive up to 100% deduction on your taxable estate. The advantage of doing this, obviously, the charity now has control of the policy moving forward. The donor does give up access to the cash values and obviously control of the policy moving forward. One other thing I would share with this, if you do decide you get to a point in your life where you don't need the life insurance policy, it served its purpose, and I would like to donate it to my favorite charity. One thing we always advise clients on is just be aware of your total insurance needs. Make sure you don't still have an insurance need moving forward. The reason why I mention this is we all have a maximum amount of life insurance we can buy on our lives. So if I donate a $10 million policy, let's say, to my favorite charity, and then fast forward 5 years later, I remarry, I have stepchildren in this marriage, and now I want to do something from an insurance standpoint to benefit those kids. As I apply for insurance, the fact of the matter that there is still a $10 million policy out there on me will come into play when an insurance carrier decides how much insurance you can apply for. And potentially that could limit the amount of insurance you buy moving forward. So I always caution people, before you decide to donate your policy, make sure your insurance needs are met as you move forward throughout your lifetime. Next slide, Pat. So obviously a common situation we see that comes up, and when I think about donating to our favorite charities and so forth, donors like to give a gift and see it be used immediately. So I like to give money to my favorite charities or my favorite causes and know that that money is being utilized today to benefit that organization. Charities like the cash gifts because they can utilize them immediately. So there are some benefits there, but there are some ways you can split the difference. And this is just a hypothetical up on the screen that I can walk you through, but let's assume we have Jim, who is 65. He's been contributing or donating to his favorite charity over the years. Looking at life expectancy, he expects to continue to donate $50,000 a year for the next 20 years. Obviously, when Jim dies, the charity itself will stop at that point, or the gifts will stop at that point. So one alternative for Jim is to go out and continue to give his $50,000 a year, but to work with the charity to say, hey, let's apply for a life insurance policy on myself that the charity would own and also be the beneficiary. In this example, the charity goes out and buys $1 million policy on Jim. We have it paid up after 20 years with an annual cost of $24,000 a year. In this example, the charity gets to retain $26,000 of that $50,000 gift that they can utilize immediately. The $24,000 goes to the life insurance policy that will help leverage Jim's lifetime gift to the charity. And when you look at the benefits across the board, if Jim had just stayed with his normal gifting strategy of $50,000 and essentially had passed away 20 years from now, he would have gifted $1 million to the charity over that time. With this split approach, in the same example, Jim now gifts over $1.5 million to the charity based on the life insurance policy coming into play and being paid out at his death. Again, enhancing his overall gifting strategy to his charity over a 20-year period. The last thing I'll close on this, and before we can go into questions and open it up, is understand there are other charitable opportunities out there from a planning standpoint. And I would always advise work with your estate planners, your financial advisors, determining your needs or opportunities if you do want to create a gifting strategy for your favorite charities. There are ways to take highly appreciated assets, place them in a trust, be able to generate income, not only for the donor or the charity, but also be able to leave a substantial benefit to your charities or beneficiaries moving forward. So those can always be designed from a planning standpoint. So I would encourage you to sit with your financial advisors and explore the situations that may be available to you. With that said, let's go ahead and kind of open it up for questions.
Terrific. Thank you, Pat. Thank you, Keith. That was very informative. We do have one question here. Thoughts on annuities? Examples of variable insurance products?
Pat, do you want to take that one quickly? You got to unmute.
Can you hear me now?
Yes.
Yes.
Okay, so I just want to get some clarity. Annuities as it relates to life insurance or just annuities in general?
As an investment, I think.
I'll tell you 1 second. Overall.
Well, I mean, look, it's a very broad question. There's many different types of annuities that are out there. You know, there's variable annuities that are meant to provide for guaranteed streams of income. They act as a pension. One of the probably most pertinent annuities of today are indexed annuities, wherein they provide a form of principal protection. And I've personally been utilizing that a lot in the current market conditions that we're in. People are concerned about their investments. This particular strategy allows you to build some principal protection into the portfolio, and it puts a cap on the upside. So I refer to it as having guardrails on your portfolio. So you have an upside cap, you're in an index like the S&P 500, and you have downside protection up to a certain buffered amount. And then there's fixed annuities, which right now you can't get any type of interest rate in those. So there's many different types of variable annuities and indexed annuities. The biggest kickback with annuities is typically fees. Variable annuities that provide income guarantees typically have higher fees to give those guarantees. The index strategy that I just alluded to, the benefit of that is not only the protection on the downside, but also that there's no inherent fees built into the product. where the fees are built in. So in other words, if you have a 30% cap and the market up 35%, you're not getting that spread between 35. So those are very, very opportunistic types of annuities that people are utilizing today.
Thank you, Pat. That's great. That's really great. We're not getting questions, but we are getting comments about your presentation, and everyone thought it was really good. There is another question here. I'm looking on my phone. What are the first steps if someone, doesn't have a life insurance policy? What's the first thing that they should do?
Well, the first step is to either sit down with myself.
Of course, we know that already. That's a given, Pat, okay?
Exactly. No, but I mean, look, it's to schedule an appointment to really assess your overall situation, what the goals are, the needs, the objectives. I don't advise in a box. I need to understand what your current situation looks like, your liquid assets, your retirement assets, your mortgages, your debt. So the first step really is an initial consultation. That's what we provide, is an initial consultation where we gather a lot of information. We ask a lot of questions. Once we gather that, the second meeting would be more of a strategy meeting. And then the third meeting would be an action meeting to move forward on any of the potential proposals that we have.
No, I'm glad you said that. I mean, it's sort of the way we approach, the philanthropy part of it. When I sit down with potential donors, everybody really needs to know what's their plan, what's their goal, rather than just go through the motions, filling out an application.
Right.
Because down the road, sometimes then they realize that maybe this doesn't meet their needs. So you really, that's great. You really do need to think about what is the goal first? What are you trying to achieve? Because it may not be life insurance. You may be able to recommend maybe another type of financial vehicle for them. So that's very good. We have another question here. The viewer says, when I divorced, there were 2 life policies on my husband, one with a cash value and one term. And I was advised to take ownership of these policies to make sure premium was paid by husband. In 5 years, husband no longer has to pay the premium. What issues should I be aware of? And then wait, there's an addition. The ex-husband died today. The total payout to me would be $50,000.
Keith, you want me to jump?
Yeah, I mean, either way, I'll jump in a little bit here. So,
Sure.
To Pat's point earlier, these policies should still be reviewed in terms of what's going to happen. With the term insurance, most likely a premium is going to still be required, depending on how long the term was. So if a premium payment isn't made, then that term would probably lapse at that point in time because there is no other supporting feature. As far as the cash value policy, depending on how it was funded, and again, this goes back to the review, it may be sustainable for a period of time if no premium is paid. But again, I would circle back in terms of how to review it. Do we want to continue to pay premium? Is it the right amount of coverage in terms of the protection for the family? You talked about $50,000 total. That'll go back to Pat's talk in terms of the consultation. Make sure we have the right amount of insurance in place, depending on what was the original purpose of the plan to be set up. So obviously, I think it needs to be reviewed. There are some risks, at least with the term policy. Some of those policies can be converted to a permanent policy, which may be an option. You would have to get if you're the owner of it, you have the right, you would still have to have your ex-husband be okay with moving forward with that in some sense. But that could also be an option as well. Pat, did you want to jump in on some of that?
No, I mean, I think you pretty much covered exactly what I was going to say.
Okay.
And I'm actually, the only other thing I would say is, with the cash value policy, depending on how much cash there is in there, you may want to even cash that out. That
Correct.
might, if you have the need for the money today and there's no tax gain in the policy. You always want to make sure what the cost basis is and where the current value is. If you're the owner of the policy, you have the right to cash out that policy if you don't plan on making any future premium payments.
Yeah. Oh, you're muted.
I'm muted?
No, Susan is.
Sorry, thank you. I did mute myself. Thanks, Keith. But that raises another question. You're married and you set up these policies for you, and this is when you start thinking about a lot of like you were saying, mortality and just to protect your family and all of that. So you get married and you set up life insurance policies, and then you have a family and you may make tweaks and changes, but then you don't expect that the marriage is going to end and end into divorce. What does someone do to protect themselves, or what happens with that policy? Does the couple sell it, or how do you handle that when the marriage is goes into divorce?
Well, more often than not, if there are children involved, there's going to be court-ordered life insurance. I work with a lot of matrimonial attorneys. Just by way of my background, I work with a lot of attorneys in general. But when I'm dealing with matrimonial attorneys, 9 times out of 10, if there's children involved, there's going to be court-ordered life insurance. And I'm in the process right now of helping this woman who just got divorced coverage on her ex-husband, who's mandated to comply as the insured policy, because basically what happened was he elected a single life pension and she's going to be left with nothing. So being that he elected the single life pension option, which maximizes his pension and gives her nothing, he's mandated and required to purchase life insurance. Now, if there's an existing policy, again, that would be addressed in the matrimonial proceeding with regard to whether the husband or wife, whoever it is that's in need, is going to be required to maintain that policy for the benefit of their ex-spouse.
Mm-hmm. Yeah, and the only other comment I would make is, we talked about the donating with life insurance policies to a charity. Well, you also have the ability to, depending on the situation, transfer the ownership. If you guys are split in the divorce, you could transfer the ownership. So if I owned a policy on my spouse, I could essentially turn around and transfer ownership to her. Now she owns her own individual policy. She's the insured, and she can dictate who she wants her beneficiaries to be moving forward. So you do have that come into play. Obviously not getting into the size of the policy or if there's any taxable issues, but you always have the right to potentially transfer that ownership to the insured if you were owning the policy.
Great, thank you. There is an add-on to the prior question. If I die while these policies are in effect, is any part of the cash value part of my estate? And what about the term policy? Is there a value attributed to my estate? And if I die while the husband's still paying the premium? Who wants to answer that one? Yeah, it's a 2-part question there. Did you get the first part?
Well, I'll jump in a little bit. So, I mean, as far as, the first part of it was, if I die with the policies, I'm the owner of the policies.
I'm still in effect, right?
Yeah, so she owns the policies. If she dies with the policies would be part of her estate at that point. They would come back into her estate from that standpoint of valuing the estate. Now, the beneficiary would still pay out, but in that example, I'm assuming she's the owner of the beneficiary. So it goes to almost one of Pat's examples where now the death benefit is paid to the estate, and then eventually that'll go through probate and you run into some other issues.
Right, what you were saying.
Whether it would be taxable or not would depend on their estate. In most cases, to have a taxable estate, those numbers are so high, those exclusion amounts. So it would depend on your situation. These sound like small policies, so probably would not have a taxable event in many ways. But that would be an issue. It would come back into your estate. And you would have to face the probate side of it.
Okay. I know both of you were so helpful to me because you audited our insurance policies that were gifted to the university, and that was really helpful. And I thank you for that. But maybe we could share with the viewers if anyone is thinking about making a charitable donation to their favorite organization, hopefully it's St. John's. What is the best type of policy to gift to a nonprofit organization?
Well, I mean, let me kind of jump in on this. When it comes to permanent coverage, there's really four different types. There's universal life, which is based on a fixed interest rate. There's whole life, which is based on the dividend paying scale of the whole life company. Typically, whole life is going to be the most costly form because there's certain guarantees built into those policies. There's variable universal life, which is tied to the market. And then there's indexed universal life, which has again, a floor and a cap, which is kind of the new norm of certain products on the investment and the insurance side. I guess, to answer your question, it would be based on the individual, based on their age. I mean, if it's someone that's in their 30s and 40s, typically we gravitate towards variable life. It's a market-driven over the long haul. We're shooting for higher rates of return. If it's a person that's, in their 50s and 60s, it may be more of a conservative program like a universal life or index universal life. So it's really going to be predicated on the situation, I would say. Keith, do you have anything else?
Yeah, no, I would second a lot of that. It's going to be dependent. We talked about, I think, Susan, you mentioned understand the purpose, the goal. Well, a lot of that comes into the individual. So to Pat's point, with a younger person, there may be more leverage opportunities with different vehicles. And then it's going to come back to how long the client wants to pay it for. I mean, some clients may turn around and say, I'm going to do this, and I'm going to continue to donate that premium for as long as I live. So we may factor that into the product of choice. Or if it's a shorter horizon and they're a little older, you may want some guarantees associated with that, where the university now is not on the hook in terms of coming up with a premium that they now have taken over, right? So maybe I want to have a short pay of 20 years and have the policy guaranteed to be paid up. So those would all factor in, but a lot of it, I think, comes back to the individual. What are they ultimately looking to achieve? And does it align with what the university is hoping to get out of the policy as well?
Thank you. I see that we're ran out of time. I want to thank everybody for signing on to this very informative Power Hour. Thank you for your questions, and because certainly we all learn from each other. But Pat and Keith, thank you so much sharing your expertise today. We will continue to promote our Power Hours every Tuesday at 1 o'clock in the afternoon. And so I hope everybody that is watching will sign on to our next Power Hour. We certainly have a diverse topics and hopefully one that will pique your interest. But thank you again. Everyone have a great afternoon. Pat, don't eat too many Hershey bars, okay? But actually it's Pat's birthday, so happy birthday again. And
Thank you,
you can eat all the chocolate Hershey bars. I hope you have
I'm
a big
allowed today.
chocolate Hershey cake. I hope you
I'm
have
excused
that.
today, exactly. Thank you, guys. Appreciate the time.
Thank you. Thanks again.
All right.
Take care.
Take care.
Bye-bye.
We'll talk.
Bye-bye.
Take care, guys. Bye.